Welcome back. You're still watching Market Sense right here on ET Now. We have been talking to the fund management team at SBI Mutual Fund as they are the AMC of the month right here on ET Now. And in continuing with our coverage of speaking to some notable members from the team, we are now joined by Rajeev Radhakrishnan, who's head fixed income at the fund house, to discuss the strategy that they're adopting in the current market environment towards managing the fixed income portfolios. So Rajeev, it's great to have you on the show. Thanks very much for taking out the time. First up, the GDP growth has been disappointing and inflation is likely to trend lower, at least in the near term, or that's the expectation. Do you think there's a strong case for a rate cut in June? There is some expectation building around that.
Okay, since the last review of the RBI, all data points with regards to inflation have been fairly positive and supportive for the bond market. So we've had CPI consistently undershooting initial expectations. The core CPI has moderated. The expected mean reversion in food prices in the summer months, that hasn't happened. And finally, commodity prices have been well behaved. So all of these factors have broadly given a very positive undertone to the bond markets. And at this point, there is a bit of expectation in markets whether the RBI would change its policy stance in the policy review in June. But our view has been that at least for the coming review, it's unlikely that the policy stance changes or the RBI goes in for a rate cut. What is more likely is that the RBI acknowledges that the recent data or the trend in data as regards the consumer price inflation, those have been fairly positive, but broadly we believe that the cautious stance of policy review which was exhibited in the last review meeting, I think that should continue. A couple of reasons why we believe that the RBI should broadly remain cautious, even as they acknowledge that some of the downside risk on the inflation have started to materialize. The primary factor again comes in from the fact that the policy target is to have a forward-looking durable consumer price inflation around 4%. So even as the recent data has been quite positive, I think we would need a little bit more data to really validate whether this is structural, would this last, and would you have an inflation number on a forward-looking basis closer to 4%. The second factor would be some of the upside risks which was mentioned in the last review, especially with regard to the potential of inflation likely to move up in the second half. And most of those, even though some of them have receded, I think it still remains. Let it be the impact on GST impact on inflation, the impact of pay commission recommendations, and relatively sticky core inflation. So I think at this point the RBI would be far more comfortable if their if actual inflation numbers undershoot their target rather than risking an overshoot on the higher side. So I think that is second reason why they should remain cautious. And finally, one needs to understand that over the last 6 months, liquidity conditions in the market have been extremely supportive. So indirectly, there has been a lot of, I would say, monetary easing out there in the system. So from that perspective, an incremental cut at this point, I'm not really sure how effective that would be.
In the current context, though, how would you be allocating funds from a short as well as a long duration perspective?
Yeah, see, broadly, we are confident that we are settling in for a stable inflationary environment. Of course, in the last 1 year, we've seen a significant easing in interest rates. Liquidity has been quite ample, and there has been a lot of capital gain across bond products. I think going forward, broadly, one needs to tone down return expectations because given the way the policy stance is evolving, it's more likely that on the portfolios, the concentration on having a higher carry, I think that should predominate. And broadly from the current stance, short medium term products I believe would be the best bet in the current environment.
What about return expectations then, Rajeev? Returns that investors could expect from fixed income products over the course of the next 6 months to a year, or even an extended period of time, because the long-term returns coming in from fixed income products are quite steady.
I think 6 to 1 months in any fixed income, especially a duration product, would really be a very difficult, I think number to estimate. But broadly, our sense is that fixed income products, especially as I mentioned earlier, the short to medium term products, there is a fair bit of opportunity in those categories in the current interest rate environment. So the broad ballpark number would be most of these funds should be able to generate at least 100 to 150 basis points higher than the safe bank fixed deposit rates, where typically we see a lot of fixed income allocation going into. Broadly, I think one needs to understand that going forward, the role of capital gains in fixed income product return, I think that would be lower, and it would be largely a function of the underlying accrual or the carry of the product. So from that perspective, broadly one needs to moderate return expectations relative to what we have seen in the last couple of years.
And how much percent, Rajeev, of the funds of do you think a retail investor should be in fixed income versus in equities?
So that broadly would be determined by the individual investor's risk preference. But having said that, I believe there is a significant potential for retail investment into fixed income funds. If you go back and see the historical trend, it's largely been either bank FDs or the traditional insurance products or the small savings, which have been the major chunk of a fixed income allocation for a retail investor. But given the fact that small savings rates are incrementally getting benchmarked to market rates, again you have amounts that are capped to the extent that you can invest in these funds, fixed deposit and most of the bank savings fund products, the returns have, or the interest rates have come off meaningfully, and this is likely to be a structural trend. So from that perspective, there is a lot of leeway for retail investors to allocate more to fixed income funds, largely with a 2-3 year investment horizon, and I think that is going to be the big growth that we might see over the next few years, wherein the exposure of retail investors to fixed income funds, let it be short-term funds or medium-term funds or even the credit funds, I think that should significantly go up over the next few years.
Rajeev, great to have you on the show. Thanks very much for sharing your ideas and your management strategy, your fund management strategy essentially with our viewers. I appreciate your time as always. Okay, that's the AMC of the month, but coming back to the